All right, how's it going, everyone? My name is Amos, and welcome back to the channel. Today, we're going to be talking about all of the stocks that are going to be reporting their earnings this week. And it's going to be a laid-back environment, absolutely different from the usual content when I have a lot of energy and I'm hyper. This one, think of it as like just two dudes talking it out, and I'll just be giving you the down low on what happened. But before we get into it, let's go ahead and give a quick recap of how last week's watch list went. The first one we're going to talk about is Centene Corporation, ticker symbol CNC. They're in the health insurance business that makes about 92% of its revenue from Medicaid and Medicare, aka government fundings. And I'm going to be completely transparent with you. Dude, it was really messy and ugly. But they did have some good news sprinkled in. They reported their first earnings loss since 2012. Can you believe that? This company, if we take a look at their financials, they've been crushing it year over year consistently for the longest time, but because of all the headwinds and all the setbacks that all the health insurance players are facing right now, yeah, this number is supposed to go down to $1.75. So in the trailing 12 months, it's $4.08, the earnings per share, which is the net income per share outstanding. Their guidance is $1.75. And they said they attributed this to a lot more treatment and surgery claims than expected from their customers. But on the bright side, and if we take a look at the numbers year over year on a quarterly basis, their revenue went up by 33%. That's actually pretty remarkable given the circumstances that they are trying to navigate through. So $48.7 billion in the past 3 months, or 90 days, whereas in the exact same time period of last year, Q2 of 2024, they posted $36 billion. So even though their net income and their profits and their margins got squeezed, the stock did go on an initial sell-off, like as you can see right there, but they rebounded and they ended the day in the green by 6% after their earnings presentation and call. But more importantly, when it comes to earnings, it's not just about what happened in the past 90 days. It's also about the guidance, the outlook, what's going to happen for the rest of the year. And they actually gave pretty bullish guidance in that they're going to go back to the table and renegotiate their Medicaid reimbursement rates with the government to get better margins eventually. All in all, when it comes to Centene Corporation, I think it was bad earnings for the past 90 days. I mean, the revenue looked pretty remarkable, but the important thing here is the good guidance that they gave for the future. They're thinking that the worst is behind them now. So, and because the market is forward-looking, that's why they still ended the day positive 6%. So between you and me, I think Centene has reached its bottom. And I bought shares of Centene because I genuinely believe in them as a recovery play, and I think I can compound my initial investment in them within 3 years or so. Buying it at a very historic low price like this, with a PE ratio of 6.9, for me, I'm willing to take that bet. I mean, what is this? The exact same price as in February of 2015, 10 years later. Come on, guys. And I'm not saying past performance is indicative of future gains, but the numbers that they're posting right here, this is the total revenue, by the way, $159 billion. Take a look at their free cash flow real quick. $1 billion in the trailing 12 months. I think I'll be okay. I'll keep you guys posted though. And the next company that I want to circle back on is Domino's Pizza, DPZ. They posted their earnings and it was nothing short of fantastic. They basically told us that their US business model, the delivery, carryouts, back to normal and it's thriving. And they have also added DoorDash to their delivery partnership because for the longest time, they kept it in-house, right? Domino's, they refused to utilize the third-party delivery people like Uber and DoorDash and everything. But once they started integrating them into their system, they're seeing their business thrive. And also, the guidance that they gave for the future, pretty darn bullish. Now, the bad news, Well, they're not doing too hot here in Japan. I live in Japan, and I can tell you that Domino's, yeah, it's pretty much empty every single time that I ride my bike past my neighborhood Domino's store. And they also missed their EPS expectations because of ingredients costs, right? With inflation, it's a little bit more pricier for the price of dough, cheese, marinara sauce, but still, the stock went up by 6% from this point right here, right, what is that, 10 a.m. to the end of business day of Friday. It went up by 6%. So Domino's, pretty easy investment for me, and I think there's a lot more room to go for them. Right now, they're $4.85. My price target for Domino's is like $520 in a bear case, $540 in normal expectations, and if for some reason they become absolutely bullish, I can see them hitting $580 by the end of the year. Now the next company is going to be Lockheed Martin, ticker symbol LMT. Let's take a look at this. It's pretty rough, guys. Negative 13% year to date, and that's basically how their earnings was as well. It was really rough. I'm not going to lie to you. And their stock, after they reported, dude, it got absolutely obliterated. They went from like, what is this, like 466 at their high on July the 21st. After their earnings, it just dropped and dropped, but I think they hit their bottom, and according to my technical analysis, they did hit their lower Bollinger Band, and they are bouncing back up, so there is a line of support at that 410 range. Guys, it was not really pretty. However, because their stock got punished really harshly, between you and me, it gave me the opportunity to finally buy in. Listen, I've been talking about these guys year after year for, I think for the past, this channel's been around for a year and a half now, but in my own personal journal and in my personal notes, they've been on my watch list for like 7.5 to 8 years. So to finally be able to buy into them, I was pretty stoked. But here's the thing. Their earnings, let's talk about the earnings, okay? Their net income, it dropped by negative 80% because of setbacks in their R&D and production promises to their clients. And they couldn't really talk about it too much because when it comes to like military stocks like Lockheed Martin and the stuff that they're producing and manufacturing, there's a lot of classified information that the general public is just not allowed to know. Only their clients, which is usually the United States Air Force and the United States Space Force. And they also cut their guidance for the year by a huge chunk. I think it was supposed to be like $27, $28, and they cut it down to like $21, $22. That's a lot. And I know, just hearing my voice talk about this, it sounds like a dumpster fire. So why in the world did I buy in? Because when I think about Lockheed Martin's economic moat with their products, their F-35 jet planes that are replacing the F-16s, their THAAD missiles, and their role in the the Golden Dome that we're going to build up here in the U.S. in the next year or two, I'm pretty bullish. And plus, when you think about their products and services, who else is building fighter jet planes? The United States Air Force. Of course, Boeing is going to do it with the F-47. But right now, when you look at the Air Force's arsenal, dude, Lockheed Martin, economic moat beyond belief. So for me, I felt like it was an easy call to buy into a high-quality dividend compounder with cheese. And look, 9,000% total return with just their share price appreciation. And I guarantee you, if we were to have baked in their dividend yield of 3% into that, it would have been a lot higher. The point that I'm trying to make is this company is going to do just fine. Yes, they did have some setbacks. I personally think it's temporary. Now, the next company that I want to talk about is NextEra Energy, ticker symbol NEE. They were featured in my utility industry breakdown video, and for their earnings, they absolutely crushed it. And I'm telling you right now, the utilities have a very bright future because of the AI data centers' power consumption. They use so much electricity, it's bonkers. However, even though they posted a really good earnings report, and good guidance for the future. They were talking about how their growth rates and their CAGR for their dividend and all their numbers should be like 8 to 10% or something in that range. They still went on a sell-off. So I think it was priced in. So the market is like, you buy on the rumors and you sell on the news. So they already priced it in that they were going to have a good earnings report, and then they sold out them. It makes no sense to me. Personally, between you and me, I do think NextEra Energy is pretty high quality. And as you can see by their stock price pattern, at least in the past, year to date, every single time they do reach a valley, they do tend to rebound. So if June is anything and they reach their low of like $69, they're probably going to rally back up. So right now, they're probably going to go all the way down to like 70.50, 70.25, and they'll probably rebound. Right? Like there's peaks and valleys. This is a company that I personally want to own in my portfolio. However, it has to be the right price. Did I say rice? Dude, I'm so freaking hungry. It has to be the right price point. And I think for NextEra Energy, my price target is 65 and under. So if they do in fact go around $65, I'll probably pull the trigger and pick up some shares. The next company is Chipotle Mexican Grill, ticker symbol CMG. There's no way to sugarcoat it. They had a pretty weak earnings. Their sales dropped because of reduced foot traffic, and they think it was because of the California wildfires and less people visiting their stores. And they said an interesting call out is they observed that in the past quarter and a half, less and less of their customers are eating beef. So you know how they have like the barbacoa and the steaks? Instead of that, they're opting for the chicken, the lower priced protein option. Friends and family, there's no way for me to manipulate it or twist it. It was pretty bad. It wasn't a good earnings report, but my confidence in the company is still intact. So for me, I decided to double. So look at this. Right before their earnings report, they were like $58. After their earnings report, they dropped by so much. Their 52-week low, their one-year metric, $44.46. I wasn't as lucky. However, I did decide to double down. My cost basis for Chipotle is like $46, $47, but this was a really good opportunity for me to double down, and I doubled down at $45 a share. I think they'll be just fine in the future. Obviously, the past 90 days, not so good, but I think Chipotle will be okay. And last but not least, let's go ahead and talk about Google. They also posted their earnings, and this is a company that I have been dollar cost averaging and buying so many shares of under 189. So every single time it was 189 or less, I kept buying a share or two. And sometimes, I think back in April, I got crazy and I even bought 10 shares at a time. Because I truly believe out of the entire Mag 7, take into account Microsoft, Apple, Meta, I think that Google is the cheapest. They're still undervalued. For what they are doing, to have a trading multiple of a 20 and a forward trading multiple of a 19, it doesn't make sense. Their earnings, as I predicted, they crushed it across the board. It was simply amazing. When we take a look at all of the Google search line of business, right? People like to say, oh, they're done. AI is going to snatch it and they're never going to let Google catch up. Then why is it growing at a double-digit rate year over year? Their Google Cloud up by 30% year over year. YouTube, 12%. Guys, this is just, Google is probably the easiest yes in the stock market. It doesn't take a genius to make money off of Google. When we take a look at their earnings for the 90 days that ended on June the 30th, their revenue went up by 13%. Their earnings per share went up by 22%. Can we just take a moment of silence? Let's just observe their earnings per share growth year over year. And as a reminder, the EPS is the net income per share outstanding. 31% year over year, 36% year over year, 30%, 50%, 22%. Google, I'm bullish on it. I still think there's a lot more room for them to go up. 193 is not their final form. Based on their current numbers and what they are posting, especially with the data that we're working with, I think Google should be around 215 in a very bear case scenario. 235 is my price target for them, meaning in the next, 180 days for the second half of 2025, I do think they have the ability to be in the mid 200s. Truly, I think so. And in the best case scenario, if their antitrust, monopoly, litigation, and all that goes out the window, I think that Google is going to be $300 a share. You might be like, dude, you're an idiot. What do you know? I think what's holding them down and why the market is scared to pump their money into Google is because they do have the pending breakup. I think some people are saying that Google is too big. They have such a monopoly. Their enterprise is unfair. And I think that spooks a lot of the hedge funds and a lot of the Wall Street investors. But I think whether or not that pans out, this is an undervalued company. So I'm pretty stoked as a Google investor to be up in the green. I think my average cost basis is like 162. So I'm in the green by a pretty good chunk. Pretty happy camper. And now let's go ahead and talk about the week ahead. So these are all of the different companies, and there's like 500 companies that are reporting their earnings this week. And I hate to be that guy, right? Like, oh my gosh, this is the most exciting or the most important week. But honestly, this week, bunch of heavy hitters, as you can see on your screen. I don't like being that kind of guy that clickbaits people, right? The thumbnails say, get in before it's too late, with like flames all over the thumbnail. I hate doing that, but to be transparent with you, this is actually a very important earnings week. So right off the bat, we have the Mag 7 represented: Microsoft, Meta, Amazon, Apple. That's going to be huge because I think they're the sole reason as to why the S&P 500 is crushing it right now. You take away the Mag 7 and the S&P 500 would be poopy pants. But not only that, we also have the health insurance giants like United Health right there. We also have Humana, and we also have Cigna. And then we have the AI chip equipment makers like Lam Research and Applied Materials, which, by the way, ASML reported their earnings not too long ago, and they did pretty good, but their stock went on a sell-off because they said the tariff situation would probably affect their sales for the second half of 2025. So that spooked a lot of investors, and they punished them. So I think, going off of that, I think Lam Research and Applied Materials are probably going to post good numbers as well, but if they follow suit and they talk about the pending tariff situation, they will probably go on a sell-off as well. Where are my freaking manners? CVS Health is also going to be reporting their earnings. They should be a part of that health insurance giants tagline that I said. And then, of course, we also have the big names in finance, such as Visa, PayPal, SoFi, MasterCard, and Robinhood that are going to be posting their earnings. So needless to say, I don't think it takes an MBA or a PhD to understand that this week is going to be super important. The stock market is either going to reach a new all-time high or everything is going to be going into the red. Because, mind you, if Visa says, oh my gosh, consumers are spending less, there's less card transactions, and then Meta says, oh no, user engagement is going down, and Apple says, oh my gosh, our iPhone sales, terrible. If they say stuff like that, dude, your portfolio next week, I'm calling it. It's going to be in the red. But do I think that's going to happen? No. I think we're going to be just fine based on last week's earnings and based on how things are panning out right now. The big banks reported about 2 weeks ago, and they said that consumer spending is as high as ever. So I think we're going to do okay. So now let's go ahead and look at stuff in a more detailed format. So to kick things off on Monday, as you can see right there, there's 65 different publicly traded companies that are reporting their earnings on Monday alone. Friends and family, usually on Monday, you're lucky to see maybe 10 or 12 companies. 65. And I think out of this entire list, I looked at it before filming this video, and I think the only one that's on my personal watch list is Waste Management. Garbage, trash disposal services. And for me, I have a buy limit order already in at about $210 a share. Huge economic moat, and it doesn't matter if we are in a recession or if the times are good. We are always going to have to dispose of our trash. This is a company that's not going away anytime soon. So for me, I would love to buy into them. So I'm looking at it $210 a share. And then let's see if there's anything else that's worthy of our attention for Monday. I guess Whirlpool. Other than that, I think H2O America, they were featured in my water utility stocks video, but I'm not too interested in them. Spoiler alert. Yeah, I think Monday should be pretty quiet. Shouldn't be too crazy. But Tuesday, as you can see, 161 different companies. We have the heavy hitters, Visa, Procter & Gamble, United. This is the one that I'm personally going to be I don't know what the emotion is. I'm low-key excited. I think everybody is so fearful of United Health right now. There's literally no growth expectations from them. I think as long as they post numbers that aren't horrific and it's better than they expected, I think their stock price is going to be the exact same thing as Nike. Because Nike reported their earnings not too long ago, and it was absolute butthole. But it wasn't as dirty and crusty as they expected, and as a result, they rebounded, even though their numbers were decreased across the board. So that's what I think will happen, but because of the sentiment surrounding the health insurance industry, I also wouldn't be surprised if United Health just trades flat, even if they post better than expected earnings. So that's my take on United Health. And then there's also the Boeing company. Now listen, I evaluated every single defense company in the industry that serves the Department of Defense and the military. And the Boeing company is single-handedly the only military stock that I am not bullish on. I just hate the way that they do their business, their operations, and their shaky financials. Take a look at this visually. Absolutely inconsistent, or I guess over a 10-year trend, it's going down. I don't like what I see with them. And what offends me is, if you can't tell by the name of this channel, Dividend Compounders with Cheese, I like dividends. And the fact that they cut their dividend, there's a lot not to like about Boeing. If you buy into them, I just don't see eye to eye with you. I think Boeing, though, I'll give it to you. It's one of those companies where the government is absolutely going to refuse to let them fail. Because I think Boeing, the only other competitor they have is Airbus, and I believe that is a European/French company. And I think the U.S. they're not going to let Airbus take all of the market share with commercial aircraft manufacturing. So they do have a lifeline, but it's just a company that I'm not interested in whatsoever. Do we have anything else? AstraZeneca, Merck, two pharmaceutical companies that I would avoid at all costs. I don't like Booking. There's a few people that like Booking.com, but it's just not for me. Because personal experience, I think in 2010, 2011, 2012, I used to use their websites and their services and their platforms. But in the past 5 years, I always just book my flight or hotel through Google.com, the integrated interface that they have on Google. Like if you search for flights, it'll say Google Flights. I just use Google. I really don't see an economic moat for them, despite having good financials and fundamentals. Their future, I'm hesitant. You also have Spotify, American Tower, Starbucks, UPS. This is a sad thing for me to say. This is a company that I was invested into for the past 5 years. And not too long ago, I made a very difficult and a very hard decision to sell out of them. I think their future game plan, like their turnaround story that they're trying to execute, it's sound and it makes sense, but I just don't believe that their dividend is going to be sustainable. And I'm not trying to be a negative Nancy here, but I do think their dividend might be cut in the near future. If you're invested into UPS, I do wish the best for you, and I do hope they rebound back up to 140, 150 a share. But for me, I just don't think that it's a good utilization of my capital. So UPS, I mean, it was hard, right? Like when you're investing into something for 5.5 years, you kind of grow attached to it, especially taking into account all the dividends that they paid me in that time frame. But sometimes you do need to reevaluate your portfolio holdings and decide, like, are they worth it? Like, is it worth me being deep into the red with this company? Do I believe in them? And is it a wise usage of my capital? Because after selling out of them, I used that capital to buy into United Health, to buy into Centene. Like, they're also beat up, just like UPS. But I believe in the health insurance's rebound with more conviction, especially in the next 2 years, than I do with UPS. Does that make sense? Because the health insurance industry, I do like their margins and I do like their financials, and I love that they're asset light. With UPS, I think during the pandemic, that was absolutely a catalyst for them. Then I don't think they're going to see those numbers for another 10 to 15 years based on my analysis. And once I came to terms with that, I was like, ooh, okay. So they're just trying to work towards the numbers that they achieved in 2021 and in 2022. So, yeah. Anyways, what else do we have? We have Ecolab. I like Ecolab. I don't think I'll ever be able to buy into them. Because whenever there is an opportunity to buy into them, like in April, what was I doing? I was buying Microsoft and Google. I always prioritize other companies and stocks. This is a really high quality player in the water sanitization, and they do commercial and corporate hand soaps in the bathrooms, and they make sure there's no pests like cockroaches. They do a whole bunch of stuff. I like them. I think this is one of the more high-quality industrial stocks available, like Honeywell and I guess 3M to a certain extent. Cisco, the food, PPG, SoFi. I think there's a lot of hype surrounding this company, especially with what they're trying to do in the financial space. I'm just not buying it, especially at over $20 a share. My intrinsic valuation for them is $12. So they're overvalued by $8 whole. For me, I'm okay with passing up on SoFi, even though I know they have the momentum and the hype. Anything else that kind of stands out to you guys? Let's see. Stag Industrial. I like them as a REIT, but right now I'm just kind of dollar cost averaging to the ones that I already have in my portfolio. Realty Income Corporation, Rexford Industrial, and I think there's one more. If I remember it, I'll say it. Let's see. Freshworks. This is a company that's been on my radar for about 1.5 years. They're in the business of making virtual customer service platforms. And I don't know about you, I really hate that. Right? I would rather speak to an actual human representative when I have an issue. Like, there's nothing that drives me up a wall more than buying a product that's faulty or you needing a refund, or you know what I mean? Like, you need service and you call the number and then you're talking to a robot. Like, that pisses me off, right? However, that's the direction that corporate America is going towards. Freshworks is in that space. So for me, like, even though I hate them as a consumer, that is the direction that the businesses are going towards. So they are on my radar, but they're not priority, if that makes sense. Let me see if there's anything else that is wild. Cheesecake Factory they were on my radar for a hot minute, but I deleted them about 1 year a year and a half ago, I decided I'm just going to continue with the ones that I like, which is Chipotle, Texas Roadhouse, McDonald's, and Domino's. Cheesecake Factory they're okay. But just, I guess if I had to rank them, especially among like the food stocks, they wouldn't be in the top 5, if that makes sense. So if they're not in the top 5, why would I bother investing into them? I guess that's my rationale. JetBlue, absolutely not. Dude, Groupon and their fall off needs to be studied. I remember there was so much hype surrounding this company. And at one point, whenever I needed to sign up for like a temporary gym membership, because I used to be in the military, knowing that I'm going to PCS or TDY within like 3 months or 6 months, I don't like signing up for permanent gym membership. Does that make sense? So I would always go on Groupon. This is like 2012, 2013, 2014. Okay, the timeline. I would go on Groupon and look up whatever gyms had 60 or 90-day deals, and I would do it through Groupon. But, oh my gosh. Well, take a look at it, Max. Yeah, I think that's a compelling story. 485 on their IPO, initial public offering, when they debuted on the stock market, and it's down by negative 94% all time. Like friends and family, I think Groupon is a perfect example of a company that you want to avoid. As an investor, don't you want to see your company that you have part ownership of, to be growing year over year? This is the exact opposite of what you want to see. It's pretty atrocious, and I'm surprised that they're still afloat. Are they profitable? They're not even profitable. Negative $1 per share. Take a look at their balance sheet. Surprisingly, they have $226 million of cash and cash equivalents on hand. The cash equivalents is this part right here, short-term investments or equivalents. And it's basically money that they have invested into bonds, money market funds, CDs, anything that's pretty liquid. So it's cash. Their total debt, $252 million. So once they pay down their debt with their cash and cash equivalents, they have negative $25 million. Their balance sheet is not the worst thing in the world, but I am not interested in this company. I'm just trying to show you guys what a terrible stock in a business looks like. Wow, color me riddled. They actually became positive free cash flow in 2024, but I still would not buy this company. I think it's a dying business model. I think, to be honest, Groupon kind of reminds me of Yelp. I think Yelp used to have an absolute economic moat in that your business, restaurant, or whatever you operate, that's where people would go to look at the reviews, to look at the pictures of the menu, and everything, right? And with Groupon, to Google for deals. The fact that I even said that, Google, right? I think Google single-handedly destroyed Groupon and Yelp. You don't need Groupon or Yelp anymore because it's integrated into Google. And it's just like Amazon as well. I think Amazon unfortunately ruined a lot of industries and businesses as well. Is there anything else on Tuesday? There's a real estate company right here. Oh, there's Rocky Brands. They do boots for the United States military. And one thing that I heard is that the DoD or whatever, the SecDef, I don't know. I don't remember who said it, but someone important in the DoD said it. They're trying to bring boot manufacturing back to the U.S. And if that does pan out, this is definitely one of the companies that's going to benefit. Me personally, I was never a Rocky boots kind of guy. For me, the tried and true, the reliable was Danner boots. That's the ones that I wore during my infantry training, during all of my rucks. The Danner ones are where it's at. And I think as a second place, I think it was the Nike ones. I don't even know if Nike still makes combat boots, but I would definitely go with Danner and Nike. Rocky is not my thing. Neither is Oakley boots. I don't know. Just not my thing. Anyways, let's move on to Wednesday. Oh my goodness. Friends and family, 251 companies are reporting their earnings Wednesday. The heavy hitters, we got Microsoft, we got Meta, ARM, Qualcomm. Oh my goodness, there's so many. And there's Altria. Altria is a company where I did a deep dive and an analysis on about a year and a half ago. And to be honest with you, I thought they were trash, right? But once I started looking into their financials and everything, I was like, hey, this company is kind of stable, kind of mature. Case in point, if you take a look at their revenue, right? 2015 was 18 billion, and now it's about 20 billion. They're not necessarily shrinking or growing. They're pretty much flat. And now that their growth phase of life in their business cycle is stable and just flat, now what they've been doing is just executing better margins, because even though the revenue is pretty much flat, look at the growth. Okay, I guess 2019 is a bad example, but let's go from 2020 all the way to now. Their net income per share is $5.99. So they're improving their margins. They're making their balance sheet look pretty. $4.7 billion of cash and cash equivalents on hand. Total debt, $26 billion. And if we take a look at their dividend profile, mind you, this is a qualified dividend payment, meaning it's going to be taxed at the capital gains rate, 0, 15, or 20%. I doubt many of you guys are in the 20% bracket. Most of us are probably in the 0 or 15%. 6.8%, that's a rate or a BDC dividend yield numbers. And it's absolutely sustainable. So for me, I bought into Altria just for the dividend income that's growing year over year, but it turned out to be better than expected. I bought them at around like this right here, under $42, $41 a share. And I'm up in the green by a pretty good chunk for a company that people were saying they're done, they're cooked. So Altria is a company where I like. I don't plan on selling them. I hate their business model. I hate their products. I hate what they do to people. But as an investment that gives me dividends, pretty solid. Robinhood, GSK. Dude, Carvana's story is so perplexing. At first, I thought their business model was ridiculous, delivering the cars to the person rather than them coming to a dealership. But having that kind of an agile business model and lower overhead costs, dude, they're crushing it. Just look at this. My goodness gracious. Take a look at their financials. It's a pretty Cinderella story. 2015, $130 million of revenue. Now it's $14.8 million. If we take a look at their revenue to their market cap, $71 billion market cap to $14 billion of revenue. Carvana is a company that, low-key, I wish I bought into. And I'm not even going to lie to you, I was eyeballing them in 2023 when they were about $10 a share. But at the time, I think I was like, the used car market, the prices are inflated, and I just don't know if that's the reason why Carvana is succeeding. But come to find out, their business model is just what the customers prefer. So consequently, a lot of the Gen Z and the people that are buying their cars for the first time, instead of going the traditional route to a car dealership and negotiating on the out-the-door price for a new truck or a new Honda Civic, they just buy it on their phone and get it delivered to their house in 3 days. So hindsight is 2020. Carvana is definitely one of those ones where I kick myself in the head for not investing into. What else do we have? We have the American Electric Power Company, Allstate Corporation. They were featured in my insurance industry breakdown video. Public Storage, which I feel so sad about. I wrote an entire script breaking down all of the various REITs that are in the self-storage space, but I'm so backed up on my video log. There's literally over 100 video scripts, and I'm just like, man, some of them get buried deeper and deeper, and they'll never see the light. But one of these days, I'll come around to making the video about the storage industry. Ford Motor Company is an absolute no-no for me. There's Hershey Company. I think they'll be okay. I don't think they're going to crush their earnings, but I think they'll be okay based on how things went for PepsiCo. Cognizant, the consulting firm. We got eBay, Fair Isaac, Prudential Financial. They're featured in the insurance industry video. VICI Properties, this is a REIT that I'm not bullish on. They're too concentrated on one territory, which is Las Vegas. And it's just, I don't buy into the investing thesis. Yes, they have good numbers and data. It's just on a personal level, I don't see the hype in Las Vegas. I think Las Vegas is seeing the consequences of people leaving California to Las Vegas during the pandemic. But let's just see if that trend is going to continue. Are more and more people going to move into the state of Nevada? Or was it just a pandemic thing, right? So, see, that's another self-storage REIT right there. Extra space storage. American Waterworks Company. And this one right here, I'm super bullish on because a water utility company with the biggest footprint in the United States of areas that they service, I love them. And the best part is they're pretty beat up right now. So if they do in fact go on a sell-off, I'll be using that opportunity to pick up a share or two. My buy price is probably going to be around under 125 or less. If that pans out, I'll be a happy camper and I will in fact pick up a share or two. If I'm feeling bold, if I'm feeling great, I'll pick up two. And then we have another heavy hitter in the health insurance space. Half of their business model services the United States military for TRICARE. So I think their business model is pretty stable, but obviously the stock market disagrees with me. I'm just reading and seeing if there's anything else. Sprouts Farmers Market, dude, this thing is a ridiculous story. Check this out. A grocery store chain that sells, I guess, like higher quality organic stuff. Take a look at this. Take a look at this. 360% total return since 2013. Friends and family, that's absolutely a compounder. Yeah, I love the grocery chains. Not all of them, but I think Sprouts is probably one of the higher quality ones. I think the lower quality one is probably Albertsons. They're not doing too well. You see that? They're not doing too well. Past 5 years, total return for their share price appreciation, no dividends, 24%. But if we bake in the dividends, I'm sure it would be a little higher. I think if I had to buy a business represented in the grocery space, well, one, I would probably buy the end products like General Mills or PepsiCo, but if I had to, it'd probably be Walmart. I think Walmart, year over year, they're slowly taking up more market share in the grocery space. I wouldn't be surprised if Walmart right now is probably 50% of the grocery market share. Let me look this up. What is Walmart's market share in grocery? Let that load, and I'll let you guys know. Let's see. Okay, they're nowhere near 50%, but they are 25% of all U.S. spending in groceries. That's pretty wild. The next biggest one is Kroger at 8.9%, Costco at 8.5%, Albertsons at 5%, and Publix at 4.1%. So Walmart has the biggest piece of the pie at 1/4 of all dollars spent on groceries. So for me, I would buy into Walmart. Let's see. Sprouts, Sun Communities. That's like a very specialty REIT for like RV parks and those boats that you can live on. Not really my cup of tea. The expectations for them, their revenue is supposed to drop by negative 28% year over year. Earnings per share is supposed to be shattered, negative 42%. Yeah, just not my thing. And this one, they're represented, Everest Group, they're represented in the assurance industry breakdown. And if you just look at them isolated, it looks like a really good investment. But when you put them up against their peers in the competition, against all the other stocks in the insurance space, they pale in comparison. And that's why I think it's so important to compare a potential investment to their peers. You can't just look at it in isolation. By themselves, they're really pretty. But next to some of the heavy hitters in the insurance space, dude, nothing to write home about. Pilgrim's Bride, they do like chicken, and what else do they do? I know that they do chicken, but what else do they do? Chicken and pork. If you're bullish on the chicken and pork industry, I guess Pilgrim's Pride. Me personally, not really interested in them. It kind of reminds me of what I said about Cal Maine. When it's tied to a commodity like meat or eggs, I don't know. I think it's too cyclical. Because sometimes the price of beef, pork, and chicken, they fluctuate, right? It's not consistent. Then we have FMC, chemical company that I learned a hard lesson on and I sold out of. Would never buy into a cyclical chemical company ever again. I think I learned my lesson the hard way. VF Corporation, parent company of North Face and Supreme. Anything else? APR Properties, a monthly dividend paying REIT. And what's interesting about them is they only have experiential properties in their portfolio. You know, things like museums, things like arcades or top golf locations, stuff like that. During the pandemic, obviously, they got hammered, but they've made a pretty good recovery since then, like Scott's Miracle-Gro. I would absolutely not invest into them based on what they do, right? The fertilizers, soil, way too cyclical for me. And the reason being is that I would rather buy into a business where their operations, year over year, you can expect it to grow like 6 or 7 or 8% or whatever the number is. Slow and steady. But with cyclical companies like Dow or FMC or Scott's Miracle-Gro, it's a boom and bust type of operation. Sometimes they post double-digit growth in their numbers, and sometimes it goes down by like negative 50, negative 70%. And for me, I don't really like that kind of volatility. And I think that comes with, I guess, becoming more mature in the stock market. Because I think in the past, I didn't really take that into account. I didn't really care. I was like, yeah, whatever, I'll buy if it looks good on paper, like the financials and fundamentals. But now I try to steer clear of any business that's in the cyclical space, if that makes sense. Anyways, anything else? Dude, there's so many freaking companies. We have a BDC right there. There's so many freaking companies. Mr. Car Wash. Dude. That's actually one of my potential business ideas, is to open up a self-service car wash that's fully automated. That's one I am considering doing one day just for fun, but we'll see if that pans out. Udemy. I think Udemy and Coursera, pretty interesting, right? Because both of them, they're selling you education online, and then you can pay to get a certification that's like, hey, stamp of approval. Mr. Jones can read at a 4th grade level. And I think it makes sense, like their business model, but I just don't think they have an economic moat. Because what's to say that Harvard University or the College of William and Mary or Stanford University, they're not going to do the exact same thing and start selling mini courses, mini certificates in their own name, right? And I think Udemy and Coursera, they do partner with these schools and institutions, but I think the schools and educational businesses are just going to cut them out of the picture. Why keep a middleman when you can keep more of the margins and profits? So I think Udemy and Coursera, good idea, good execution, but unfortunately, I just don't see their economic moat intact. Does that make sense? Was that coherent? I hope it was. But anyways, let's see. Dang, if you work as an analyst, if you work on Wall Street, or anything to do with the equities or on a trading floor, dude, you're going to be so freaking busy on this day. My goodness gracious. By the way, if you want to know the ugliest and the most disgusting restaurant stock, it's Fat Brands. It's Fat Brands by a huge margin. They were represented in the best burger stocks video that I uploaded. And once I looked at their numbers, dude, it was horrific. So ugly. Let's see. Now we're moving on to Thursday, and it's more than Wednesday at 265. Apple, Amazon, MasterCard. Oh my gosh, so many heavy hitters. And I keep saying, and I'll say it again, I would rather buy into NASDAQ than S&P Global. I think NASDAQ is at a better value, better future, and for me, I believe in NASDAQ slightly more than S&P. I think NASDAQ is they're A plus S tier, and I think S&P is probably C plus B minus. Is that a hot take? Maybe. Looks like there's a lot of pharmaceutical companies. I keep seeing names that I recognize, having worked in the industry. Bristol Myers Squibb, CVS, Blue Owl Capital, PG&E, probably the worst electric utility company operating in the U.S. Reddit. Can we talk about Reddit? I usually don't buy a stock at their IPO because you never know what's going to happen. However, I think Reddit is a perfect example of a stock that I really wish I would have bought. They debuted at about $40 a share, and then they dropped down to what is this? Okay, they debuted at $46 a share, and they dropped down to $40. And then I was like, see, that's why I don't buy IPOs, because I was thinking they were going to go down to like $22 at the time. Did that ever happen? No, they did not. And as a matter of fact, since their IPO, 340% in the span of about a year and a half. 3x your money. So I think Reddit taught me an example that you can't just dismiss a stock just because of their IPO. And one of the companies that I applied that principle to was Slide Insurance. They're represented in my insurance breakdown video, and I bought into them. And yeah, it just goes to show that not all IPOs are traps. But I sold out of Slide, by the way. I bought into them, got like a 10 or 12% gain, and then I sold out of them. And I'm waiting for them to pull back a little bit so I can buy in at a lower cost. Cloudflare, another chemical company I am not interested in. Man, there's so many heavy hitters. This one just went through a short squeeze not too long ago. It's one of the meme stocks that people were piling their cash into. I think they're in the business of mortgage loans, and then the ability for the consumer to do everything end-to-end through a mobile app on your phone. So I think it reminds me of like the Carvana, how it's disrupting an ancient business model. We have Clorox. I really wish I bought into them during their 1 year low. It's like a few weeks ago, a month ago. I was watching them. I missed out. They rebounded, and I think that ship has sailed. Reinsurance Group of America, they're represented in my insurance stock breakdown video. Dude, there's so many companies. Oh my gosh. AES, they sell power and electricity to the data centers. Remember that name. CubeSmart, another self-storage REIT. I'm trying to see if there's any hidden gems. ADC. Okay, I'm going to admit this right now. Pound for pound, they're better than Realty Income Corporation. I know. That's a hot take, but they're better. But unfortunately, I don't think they're at a price point where I would buy into them. But I agree Realty is like S tier, and I would say Realty Income is S minus, and then I would say Triple N. They're all in the same exact business model, commercial real estate with the triple net lease, and Triple N would be like an A plus, A minus. That's how I would stack and rank them. My gosh, there's so many. SiriusXM, that's Warren Buffett, Berkshire Hathaway. Dude, they went gung-ho. I think they own a third of all the float shares outstanding, so they have pretty big ownership, and I wouldn't be surprised if Berkshire Hathaway swallows them up and it becomes a subsidiary of the Berkshire Hathaway conglomerate. Because here's the thing. I think SiriusXM's business model is stupid. I think YouTube Music, I think Spotify, yeah, they're eating up their market share every single day, every single week. They're losing listeners to YouTube and to Spotify. But I think Berkshire Hathaway, they probably are seeing value add from their satellites that are all over in space. Because I think space is probably going to be one of the biggest, I guess, the gold rush frontier in the next 20 or 30 years. I don't think anytime soon, but I think once I'm headed towards retirement, I'm in my mid-30s. Once I get into like my 60s, I think the space frontier is going to be the next gold rush. And I'm thinking they're buying SiriusXM for the real estate of satellites that they have operating outside of planet Earth. I know, that's weird. I might be wearing my tinfoil hat right there, but dude, Shake Shack is such a high quality burger joint chain. This is a stock I really wish I could buy into, but not at their valuations. 472. I think that might be higher than Palantir. No, Palantir 656 PE ratio. But a burger chain to be at a 472 when Cava, I think theirs is like an 80 or something like that. When Cava is at a 73, for me, way too expensive. But they're absolutely high quality. Shake Shack. And then we also have Columbia Sportswear. Personally, I would never buy into Nike, Adidas, Columbia, anybody that produces and manufactures clothing. I'm just not into it. Reason being is what's hot now might not be hot tomorrow. Like, what do you say? Champion and Starter, those are two sporting apparel manufacturers. They were hot in the 90s. Now they're irrelevant. Nike was hot and now it's Adidas and then it's Nike. There's just too much volatility in that industry. And there's Five9. They do the exact same thing as Freshworks, virtual and digital customer service. So that's a competitor and rival to Freshworks. Between the two of them, I can't really say which one is better. I think Freshworks might be a little bit better, but I think the best out of that entire virtual customer service industry and space is NICE. It's an Israeli-based company, and they have the biggest market share, and they have the biggest customer base. So if I had to pick one, it'd probably be NICE. Utz Brands, they were featured in my food CPG industry breakdown video. Is there anything that sticks out to you guys? Canada Goose, is that the one that makes those really expensive jackets? Treehouse, private foods manufacturer. Middlesex Water Company, yep, we covered that one. BJ's, gosh, there's so many companies. El Pollo Loco, apparently their chicken is pretty freaking lit. I wouldn't know, never tried it. As a fun fact, I'm allergic to chicken, the protein, I can't have it. I get hives all over my body, which is kind of weird. All right, so that's Thursday. That's a crap ton of companies. Friday, 75. So we got the big oil and gas players. Colgate Palmolive, Ares Management, Dominion Energy. Their numbers look like trash. They are an electric utility company operating in the mid-Atlantic, primarily in Virginia and North Carolina. But I think they do have a pretty big catalyst in that Amazon, AWS, they're opening up shop, and so many of their data centers are propping up in the state of Virginia, which means Dominion Energy has prime real estate. But their numbers right now, absolutely butthole. But they have that catalyst. Kimberly-Clark, Church and Dwight, T. Rowe Price. Let's see, anything that sticks? Skechers USA. Oshkosh Corporation. Dude, this is probably one of my highest convictions right now in the defense and military stocks space. They make industrial equipment for the airline industry, for firefighters. They're the ones who make the firefighter trucks. Did you know that? Pretty interesting, right? And they also make a lot of the transportation ground vehicles for the United States Army and the Marine Corps. Oshkosh. Remember that name, friends and family. I am invested into them. I believe in them wholeheartedly. I like them. And I think that just about wraps it up. By the way, I appreciate you guys for your feedback and your comments, and that's why I'm continuing this series. I think as long as we hit, at a minimum, 1,000 views per week, I'll continue doing this. Okay? I'll continue doing this series. This is what I do on a Sunday. I look at what's coming up this week. That way I can be ready to pull the trigger on any stocks that might go on a flash sale. Because usually when the market overreacts and a stock goes on an overwhelming sell-off because of their earnings and they go down by like negative 30%, no kidding, by the end of the day, they'll recover and they'll only be like negative 10%. So you get that opportunity for about 4 to 5 hours to buy it at a really good price. And that's why I pay attention to the earnings, but also because some of these companies are in my portfolio. I want to know, is my investing thesis still true? Is their future still good? If not, I can cut ties with them based on their earnings report. And other than that, I want to be transparent with you guys. I think in the near future, I might be dabbling into a few of the Yield Max ETF funds. I know. I still think an overwhelming amount of the Yield Max ETFs are yield traps in that there's NAV erosion. Case in point, if we pull up this one, I know this is like cherry picking, but if we pull up Tesla, take a look at this. Debuted in the stock market for $40 a share. Now it's $7, negative 80%. So if you invested $100 into Tesla, you would have roughly $20. Oh, but what about the dividends at 128%? Right? So yield trap. However, if we look at one of the heavy hitters, the one that I'm potentially eyeballing to invest into, Misty, this one is pretty stable. They debuted in the stock market at about $21 and they're $20.83 right now. So the share price is pretty stable and the dividend payout has been pretty consistent every single month, 132% yield. And the reason being is I'm buying into it so that I could do weekly updates and whatnot. I think I can make like a video series talking about like, oh, hey, how much my Yield Max ETF paid me this week. I don't know if, like, this is beyond my risk tolerance level, believe me. But I'm thinking about doing it for the channel content. Reason being is that I'm trying to plan ahead for when my first kid is born. Should be born sometime in the next 3 months. By the way, freaking scared, nervous, first time dad here. But after she's born, by the way, it's a daughter. Did I tell you guys? I think I told you guys. It's a daughter. I think after she's born, I heard that the toddler trenches, absolutely real. I'm going to be sleep deprived. I'm going to be cranky, irritated, and I'm going to be super tired. So I'm trying to plan ahead and think about the content that I can do that's easy as possible when my brain is going to be absolutely dysfunctional. So that's why I'm thinking about dabbling into Yield Max ETFs. And I feel like this series in itself, I hope it can continue on. If we hit 1,000 views, we'll do it. We'll ride on. But anyways, if you made it to the end, no one has told you recently, I'll tell you. I love you, man. Keep doing the right things. Stay safe. Good luck in the stock market. And I'll talk to you next time. Peace out.